Thank you very much, Sean. Thank you very much, everyone, for joining us for another session of our class, in hopefully informative class. Today, what I thought it would be perhaps timely to discuss something with these volatile markets that we've had. And I think right before the Labor Day weekend, which we saw the tops in the markets, there has been some jitteriness and a little bit of a discomfort with the market. So I thought, why don't we talk about a strategy that hopefully it kind of takes us through these rough times and gives us a little handle on the downside risks and let us sleep a little better at night, and also gives us the opportunity to perhaps take advantage of the gain. So the strategy that I'm talking about is called the color. And the color is almost like the color. It's like basically, it's an option strategy that the name looks pretty complicated. And we were just discussing how some of these names have come up and make things so confusing, so complicated. While when we go underneath and we analyze it, we see actually they're just basically simple strategies. Everything is a combination of really selling a call or put or buying a call and put, and that's it. Once we understand that, we can come up. I'll encourage you. It's almost like I feel like Picasso with Cubism, and come up with these old strategies. While it's like the bottom line is just a simplicity, and again, things get very much complicated when it comes to these naming of the things. So what we're going to look at is the items that I will go over, and hopefully it will be a short class, so it will be, and hopefully it will be easily digested, is first of all, what is this color strategy that we are talking about? And of course, we want to know, why do we want to consider the color? Because I don't think this is a subject in a party that you go to, or it's something that you hear much about it. And when do we use this color strategy? And then I'm going to go to, most people know about the zero or near zero, which color strategy, but I'm going to go a little further and talk to a little more advanced as far as these strategies, talking about something called laddered, something called fence strategy, put spread color strategy, staggered color strategy. So it's, again, the foundation is the same. We just want to be doing a little creative moves to take advantage of, again, these strategies. So, and as always, I like to go over my 7 criteria that I look for if you're going to do the color option strategy. I like to see the pros and cons of it and what I would look at. And then at the end, I would look at something can think or swim like hot out of the oven. It's like just something as an example, see how we can actually do that. Thank you. We'll do that. Sean, if you don't mind, if you can mute everyone, I really appreciate it. Thank you. Okay, so what is the color strategy? So basically what color strategy is, you have a portfolio. In this situation, let's say you have 1,000 shares of something. And what you want to do, you want to protect the downside of it. And in order to do that, and you're worried that maybe market's dropping 5%, 10%. So what you do, most of us as a hedge, we are very familiar with buying puts. So we go and buy a put and we pay a premium for it. What the color does says, all right, you paid for that put, but sometimes it's too much money for that protection. And what if this is kind of expensive insurance? What if it doesn't happen? Maybe we bought it for 2 or 3 months, 5 months, a month. I lost all that premium, like any other insurance that you buy. So what we do, we finance that insurance and we go ahead and sell the call out of the money. And basically now, that's what the name color comes, I believe. So now we have this bracket that we are basically capping or progress or our profit, but we also protecting the downside. So in reality, what it is, you're buying it out of the money protective or married put. And the reason it is called protective or married, we call protective is when we buy a put, when you actually own a position to protect that position. So if you just bought a naked put, that's more of a speculative, you just want to make profits. When we talk about protective, there is a purpose for this put option to protect your underlying assets. When we talk about married put, it's usually married put is the same thing, but it happens as soon as we actually initiated the position. Let's say we bought 1,000 shares of Apple. Immediately, what we do in order to protect that, we go ahead and actually buy a put on those at the money, or we can go out of the money, usually depending on what our stop loss is. So we go out of the money and buy the put options simultaneously, and that's what's called married put. So basically, the purpose is hedging that downside, right? One of the things about when you buy stock, we talk about stop loss. Make sure it doesn't move less, more than 8%. So we want to protect that. The good thing about the put options are, granted, we paying basically premium for it, but what happens with with these stop losses, there could be some really big downturn. There could be a gap down, which will bypasses your stop loss. So basically what happens, even though you put 8% stop loss, sometimes it could become 25 or 30%, especially if there's earnings coming up, or there's a flash crash, for instance. The put options, obviously, when it goes below that, then you can exercise, it can go down 18%, 20%. Well, you basically hedged that was that 8%. So that's why the put option is more attractive. So we got our protected, but what we want to do, we want to actually sell an out of the money call, because we want to finance. Because if I just bought a naked put, in a sense, and paid that premium, that could be, sometimes they add up. And if I'm going to do this every 3 months, or every 5 months, or every 2 months, they add up. So by going out of the money call, wherever desired is, that's what you think that basically, again, you are limiting your profit if you're selling that call, which is exactly, that's what it's the covered call. So you're basically marrying protective put with a covered call, and you're financing the whole strategy, your put debit. So in order to do this, you, again, like a covered call, you can, for every 100 shares that you own, you sell 1 call. So in this situation, you have 1,000 shares, you can sell up to 1,000, up to 10 contracts. One good thing is you don't have to. If you have 1,000 shares, maybe you only want to protect half of it. Maybe you buy 5 puts and you sell 5 calls. It's very flexible, so you don't have to protect the whole portfolio. So just a little graph. So in a sense, basically what you're doing, let's say you have the stock is at this price. So you're limiting your loss by buying that put. So if it continues, your stock or the underlying holding, whatever you have, keeps going down, you're protected. It's a defined risk. The con, or something that kind of, again, if you're very aggressive, it kind of feels like, boy, if it really moves up, I am missing on the upside. So I'm limiting my upside potential because you're selling the call. So if it goes above this, you have to deliver the stock at that price. So you're basically limiting. So that's the thing about the color, that it limits the downside, but also limits the upside. And this is a little better. So basically you can see this is your loss and this is your profit in a sense. So here we go. This is the movement, how much goes up, and that's where the stock price, when it gets to this, your strike price, that's it. and this is at the money. So as you can see, the best place, the most profitable way for this color to work is if it goes up and it stops right somewhere right before your expiry, the strike price that you had sold the call. So let's say this is 100 and this is 105 and it closed at 104.50. You gain on your stock and you also collected that premium for that. So that's the sweet spot. And if it goes down here, again, depending on how much, again, the debit, or if it was a break even, we'll talk about zero color, that also could be attractive, but the best price will be right around here. So why even we consider the color? We could, as I mentioned, we can just buy the put, we can do the stop losses, we can do many ways. You can do the futures, we can do vertical spreads actually, and we can, as I mentioned, we can diversify with the uncorrelated. So this is, the reason is there are times that, first of all, we are concerned about the large downside moves, and we really don't want to pay a lot of premium. Also, we think that our holding is still a good fundamentally holding, but in the near term, and I think September and October are a good example of that, in near term, you're concerns about the corrections. So that's something you're concerned with. So that's color could be attractive. Now, basically, let's say you have a concentrated portfolio. You have, let's say, you have a love affair with meme stocks. You love Tesla. So let's say you have $1 million portfolio and like $850,000 in Tesla. So now you want to protect yourself, especially we'll talk about, let's say, the earnings when it comes, or it's some kind of event. So you can use this. Now, as I mentioned, it could be technology, it could be Apple, Tesla, maybe doing financials, and now the earnings for financials are started coming out. The rest of the week they will come more. So maybe you find something to protect against that. And the other part is maybe you do have some kind of a mega cap stocks. You just don't have one concentrated portfolio. You have a lot of mega cap stocks, from Berkshire Hathaway to Apple to Microsoft to Google, and the beta of that is close to 1. So basically it follows the S&P, and now you're concerned about the whole market, and because of that, maybe you can use S&P color strategy to make sure you're protecting your downside. Another interesting thing is, this is more of a short term, so maybe you're concerned about earnings. The earnings coming up in 3 or 4 days, or a day from now, or you're concerned maybe a week from now, and you are thinking, what if there was a big drop in that earnings? So what will happen? And again, when you go buy an option, usually, especially with the volatility involved, you pay a lot of premium. So what do you want to do? Perhaps a color strategy would be attractive. Of course, the cons will be, what if it went opposite and it really went to the roof, and you're just limiting your profit. So the earnings are actually a good strategy for using the color. So but also, if there is any type of a news, especially when we talk about FDA, biotech companies or medical companies, there's some kind of event coming up, you can also take advantage of it on a more of a short-term color. And the last but not least, one of the reasons we use actually options is, what happens is when we do like stop loss, or when we are worried right now and we say, well, you know what, I'm going to take my profits. I've had a good gains, that takes the profits. And let's say this is a non-qualified regular account, you're concerned about the taxes. You don't want to pay long-term gains, or maybe it could be even a short-term gain. So you can take advantage of option strategies, including color, to avoid that. And basically taxes. How about the states? The states are, valued at a certain amount, and let's say something happened, and because of the valuation strategies, you cannot you cannot sell the stock. So basically maybe be creative and use option strategies and some other planning events. So hopefully this clarifies why the color strategy can be attractive. So with that in mind, let's talk about different strategies. And the simplest one is something called zero color strategy. And basically what it does, it tells you that let's sell an out of the money put option. And then hopefully in a ideal world will be the option that the premium that you're buying the put options is same as the option, the call option that you're selling. So that could happen. It has happened. I've done it. And sometimes, so basically the put option that you bought can be really negated by the premium that you received from your call option. So we prefer to have them equidistant because that's what you want to have the balance in your color. But sometimes it becomes, maybe there's a little debit. Sometimes the call is less premium than the put, especially when there is a downside risk. Usually on indexes such as SPY, remember we talk about skewness. So the put premiums or implied volatilities are higher, so you pay higher premiums. So we want to watch that. But in some of the underlying, they are pretty similar. So the zero color strategy says that you buy the put, you sell the call, and they negate each other. So basically, it's like a neutral zone. So you don't really pay anything. And in this case, the stock really can move, and as long as it stays between, you're good. So let's say you have an ABC stock at $100. Basically, you go buy a put $5 down. So you're thinking it could move 5% lower. So you want to protect yourself. So you pay $1.30 for this to protect yourself. And you think about it, you say, well, I buy 10 shares at $1.30. That's 130 times 10, 10 contracts. That's $1,300. That's a lot of money. So what you do, you go sell the call at 105. So now you have a 5% potential for upside potential, and you collect that $1.10. So in reality, you paid $1.30, but you collected $1.10. So really, it costs you 20 cents or $20 per contract. And if there's 1,000, then it's like 200 rather than 1,300. Now, as I mentioned, if it stays in between, then you will be good, and we can keep doing this. So every month we can maybe roll it. So we got this strategy. We bought this for a month, 40 days. It happens. We're still concerned. We think there's, we're somewhat bullish, but we're still concerned. Maybe we can keep doing that to make sure that we are protected. So let's say if it went from 100 to 104, then we can do the same thing. And now we go up 5%, maybe another $5. Let's say we do 110 and 99, for instance. So we can keep playing this if you like. If it's like a trend is very bullish, then you don't, perhaps, you might not want to do this, but it all depends. Now, as I mentioned, we like to have them equal distance if it's possible. Again, that's the ideal word, but that's how the zero color strategy works the best. And again, as I mentioned, it does cap your potential profit, but also, again, your downside risk is covered. So that's the zero color. So that's the vanilla color. But what if we want to be creative? And it's what I'm talking mostly is, when we talk about laddered strategy, is you can actually apply to covered calls also. So what is that laddered strategy? And few of your portfolio managers, as you know, in the fixed income with the bond portfolio, we like to ladder our portfolio. What that means is we want to diversify the different maturities of our treasuries. Let's say we buy a 5-year treasury, we buy a 10-year note, we buy 30-year bonds, we might do the 2-year treasury. So basically that's called laddering. So by doing so, what we are also doing is the reinvestment risk is different, and all that, as far as, again, the movement the yields also, again, it's diversified and it's laddered. So we can actually apply the same idea to either covered call, which is very similar to collar strategy, and basically we work on the selling the call. So what does that mean? Remember, be talking about protecting your downside, which is the put side. We buy a put option. So let's say you have 1,000 shares of ABC, and you know that you want to protect that and you're concerned for the next 6 months. For 180 days, you think that there is a good chance that ABC can go down, whether it's with seasonality or whatever it is, but you really like this ABC and you've got some good gains on it. So you want to protect those gains. And you say, you know what, I'm going to buy, because you have 1,000 shares, you're going to buy 10 out of the money, depending on what amount of protection you want. Do you want to go down 10%? Do you think it goes down 15%? Where are you comfortable sleeping at night? So you choose that, but you want to buy 10 at 180 days. So basically what happens is you get a one shot and you buy that. So this way you don't have to worry about it. One word of caution as far as the options pricing. Again, I always emphasize the liquidity. One of the things you have to watch is the bid-ask spread and the liquidity. As we go farther and farther in our as far as our the dates, so if it's 180 days, if it's 1 year, 2 years, really the liquidity gets less and less. So sometimes you end up paying higher premiums. So watch for that. So I'm using 180 days. You might want to use 120, but this is just for the concern that you have for the next 180 days. You don't want to keep buying the puts. You just feel, okay, let me do that. Now the laddering comes in this form, that you, rather than buying a 180-day call, I mean, rather than selling the call for 180 days, you might say, well, you know, what if, you know, there's a good chance it go hit an exercise. And so what I'll do is I'm going to ladder this. I'm going to use different expiration options dates. So I'm going to do 2 out of the money 30-day call options, 260 days, 220 days, and then I will do 480 days. The danger for this is not the danger, but as you know, you're paying for a 180-day put premium. So it's 180 days. So obviously it's more expensive. You're collecting much less. So if you would have done 180-day pure 10, so if you would have sold the 10 calls, you would have collected a lot more premium. But because you're doing this, you're collecting less premium. On the other hand, you're protecting yourself as far as the exercises, in a sense that maybe, you know, if it doesn't go hit your target at the next 30 days, well, you collect that premium that goes in your pocket. Then the next 60 days, that will be, again, more premium. So it's a give and take, right? So another form of thing, as I mentioned, you can maybe roll over the whole thing. So if you did one color, you can do it every 30 days and roll it over every 30 days or 60 days. The next strategy is, it's called something called fence strategy and the put spread color. So they're pretty similar, but except for the fence strategy, it's a little fenced in. So what it is, it's again the same color strategy, except remember what we are thinking about is we are buying a put, which is usually expensive, and we want to finance it. So what the fence does, it says, again, we sell the call, but what we do, we just go buy a put right below the strike price that we actually, I mean, but right before the current market price, but we finance that with going farther out of money on a put option, and they finance this put option. So we get the financing in 2 places. We get the financing from selling the call, and we get the financing from selling that out of money put. So in reality, you basically, what you did, you got a debit put spread, and you also got your really in a covered call in a sense. So you sold the call. So this way, your out of pocket is less, but this allows you, because you collected the premium from that out of the money for your put, it allows you to basically go much higher out of the money. So you initially in the regular color, maybe you only had to go $5 out of money because you want to make sure the premiums are similar. This way, maybe you can be more flexible and go a little higher, so your profit target can be higher and your cap is higher. Now, the put spread color is similar to fence, except with this, we don't go right below the current market value. I'm going similar what we did with the color. We just go exactly with, let's say we did the zero color, we go out of the money, and then we go farther out of the money. Again, we have this vertical spread. The debit is less because I'm doing that out of money put with the, I'm financing with farther out of money put. So now here we have a one vertical spread, which is debit, but much less debit than pure put option. And then I'm financing with the call, the covered call. Now, we do this, the reason we do this is when you have the regular color, you're limiting, basically what you're telling yourself is, if I spot that put, I am saying, you know, this way market could go to zero and I can make a lot of money if it goes down there. But what are the chances of S&P dropping 50% or 70%? So if you think that the markets would drop, but they're not going to drop more than, let's say, 10% or 20%. So basically you're putting a floor. Remember, when you're doing the vertical, you're selling that out of the money and you're hoping that you never reach that. So if it's down 20% and you feel comfortable, then why should you pay that large amount for that put option, thinking that if it goes to zero, you know, if there's a bankruptcy in the stock, you're paying a higher premium. But when you do the vertical, you're basically putting a bracket and you're telling yourself that, you know what, with all the things going on, I don't think this underlying holding, especially if it's indexes, going to drop more than 15%, 20%. So basically you're limiting out of pocket premium debit. And again, we are covering the extra premium coming from the sales. I hope that's clear. The next option strategy is called staggered color. And again, this staggered color you can also use if you do a covered call. You can also do that, and we've talked about that in the past. So again, you own the shares of the ABC stock. So what you do, you buy that the put option, but this time you just sell short dated calls. So basically it's similar to that covered call, right? So you own the stock of, again, ABC, you bought it at $100, you sell the call for 30 days, and, you know, because of theta, you know, your idea is, you know, short term it could go down, so, you know, it's not going to hit my target price, so why don't I collect premium? And as I mentioned, maybe you don't want to sell for tax reasons, so this is not a covered call. And what you do, you don't want to do for 60 or 90 days, although you will collect more premium. You think, well, what if there's a big event, especially if there's around earnings or something? So what you do, you just use the short dated, and if it goes against you, you can roll over that short dated call. So in reality, what you're doing is you buy that put again. So let's say there's 1,000 shares. So you buy the 10 90-day put contracts, and you go ahead and sell 10 30-day call contracts, and then you continue this every 30 days to finance your 90-day put. Okay, as I mentioned, it's very similar to your covered call. Now, the problem with this strategy is obviously because you're not going one-to-one, in a sense, it's not 90 days, 90 days, you're collecting less premium on the call side. So what happens is you are not, it's not zero color, it's not really, there's a lot of debit still there. Your goal is, you think the next 90 days, you're going to make up for it. So every 30 days, you're going to collect more and more premium, and this brings your costs down. So the other problem is if there's a huge moves in either way, then basically now you're really the hook in a sense. So you basically lose in some ways. If it goes up, basically you get called, and that's really minimize your potential. So that's why it's good. The color is good when there's like a not a huge move in the picture. So this. Okay, so what we've done, let me review. Again, I'm hoping it's clear. I don't want to go too much into like the details of like exactly, the mechanics of it. I think once you understand what is covered call, what is put, you just marry them together and you hold the stock. Now, before we go any further to my 7 criteria, you could also have a synthetic color. What I mean by this, almost like the poor man's covered call, right? So when we talk about covered call, most of the time you think of you actually own the holding. Let's say you own 1,000 shares of Apple, for instance, and you sell calls against it. In the synthetic, maybe you own a leap or a long-term call or a call on Apple, and you sell calls against it. The same thing with this. Maybe you have a SPY, you can buy a leap call and then basically do the same thing because of the leap, and you're going out of the money, then they kind of protect each other. So make sure your leap is longer dated than your selling the call that you're out of the money you're selling. So I just want to mention that. But majority of time, this is really good if you have a large portfolio and you just want to protect that, and especially if it's concentrated. And as I mentioned, with the earnings, we'll discuss a little more. Number one, as far as the 7 criteria, always use liquid underlying assets. Again, we are looking both legs, and we want to make sure the spread is as low as possible, and especially if you're doing laddering, if you're doing staggered. So basically make sure there are liquid underlying. So for instance, if you have a technology, got a lot of technology stocks, rather than going buying like one by one, let's say, as I mentioned, we can use QQQ, NASDAQ 100, for instance, or if you have a lot closer to Russell, maybe you can do IWM, but make sure they are liquid. And majority of time we use the spider. What I found out, if you want to have this idea, let's say it was September, and you thought, oh, it would have been great to have a color strategy. Usually the sweet spot is like for color is 30 to 70 days. It works the best. So if you want to, again, look at the ideal time for, especially for zero color, it's usually 30 to 70 days. This I mentioned before, but it is very important, the skew, which that means that usually on the indexes, there's more skewness, there's more volatility, there's more premium for puts versus calls. On the other hand, we've talked about meme stocks, let's say GameStop or even Tesla. They have more premium and implied volatility to the out of the money calls than puts, because there's a lot of, again, enthusiasm, when it comes to that. So just be aware of that. So when you're building your color strategy, adjust assignment risks and dividends. So what I mean by that is, remember, when you're selling a call, you are obligated to deliver. So whether you do covered call or you're doing the color, that the selling part of this thing is there's obligation. So always be aware of that the whoever has bought that option with a call can always exercise that, and you can be assigned. So don't think that's because the price is not there yet and it's not the end of the expiration, you cannot be assigned. No, this is American style, you can always be assigned. One of the keys are the dividend X date. And what that means is there are some stocks, and that's what you have to be careful with your underlying security to see if it's a dividend paying stock. Remember that there are times that, because when you have the options, you don't have entitlement, So they want to assign, and right on the X date, right before a day before X date, you could be assigned. And the way to look at that is if your extrinsic value is actually less than the actual dividends, the person who holds the call is going to say, you know what, I'm willing to pay the premium for this call and get it exercised because I'm going to get a juicy premium. So be aware of that. So watch the dividend dates. So pre-earning strategy, especially short-term play, and I mentioned about FDA. So if there's earnings coming in 2 or 3 days and you don't know which way it will go, this would be a good way of watching. I would go back and look at past 4 quarters. I would go actually 12 quarters because I want to see, exactly a year ago, my quarter, how did it behave? I want to go 2 years prior to that, 3 years. So you want to see that. And if it has been negative and you're concerned about it, then that might be a good position. So watch these earning dates. So the sixth one is don't forget about the theta. So remember, the theta plays a role with both options. So watch that. Let's see, again, it is very important, and that's part of your extrinsic value. So watch the time. The time value is important. And I'll be talking about, if you're talking about the short-term call options versus the long-term put options, you want to evaluate that. And that brings me to the seventh thing, and that the thing with the option strategies is not something that you just close your eyes and let it go. It needs managing. I put down TLC, especially with color, especially if you're doing laddering, especially if you're doing staggered, if you're doing cover calls. You want to watch that. You want to, it is a business. That's what you have to look at it. So it needs the really tender loving care to make sure your positions are going to the way that you like them to be. All right. So I thought that just at the end, I would like to put a little example. This is just after close. This is gold trade. So gold had a really nice move today, as you know. And what happened was the gold did go up nicely. And let's say you hold gold. Let's say you just bought gold right now. And you say, you know what? It has been pretty volatile. So what I like to do, I just bought, let's say, 1,000 shares of GLD ETF, gold ETF, and I want to protect myself if it goes down 5%. So what I like to do, I'm gonna go look at November, which is about plus 30 days. We have about 37 days, so that's a good number. And this is from Thinkorswim. You go to the color with the stock. That means you hold the stock and you would like to have a color strategy. And basically all you have to do, ignore these. So if it's, you can just choose one of these. So if it's 5% of 167, it's about 8 or 9. I put down $10, right? So you look at it, say, you know what, I like to see if it goes up 10 or if it goes down 10. And mainly I'm talking about if I lost $10 out of this at 157, 158, I like to be out of this, or at least, I like to protect myself if it was below that. So what I look at is, you just come here, let's say I did 168, and you just sell it. So basically this becomes your order. So you're selling 10 calls at 178, as you can see, and then you're buying that 158 put, which is the same expiration, November 19th, and you hold 1,000 shares of GLD. And basically what it says, that debit is 167.71, but I will explain the next how we get to the real cost of the option. And because remember, 167.59 represents part of that 167.71 because it includes 1,000 shares of GLD. So how we got to that is basically what I did. I received 43 cents on 178 call. My apologies, it just went. But basically what happened was that the 158 put was 11 cents more than this, so it was about 53 cents. So I have a debit of 11 cents. So it's almost zero color. And that's what that 11 to 12 cents, that's what that one, 67, 71 comes into the picture. So basically this whole strategy, it costs you 11 cents. So how we look at this on the graph, that means that in a situation like this, it's basically like that. Should mean the opposite. So I mean, we can see that. Just look at this. Oh, that's the reason. This should be reversed. My apologies. I have to change this. By the way, so this actually shows we bought 10 calls and sold 10 puts. It should be the opposite. So this whole thing should be reversed. So this will be up here and this will be down here. So, and you can see the break even is like at the strike plus 11 cents. That's our, so the idea is, again, this should be reversed. So we go up here and basically that's caps at this at 167.71, and then the put side comes down and it capped at 158.11. So basically that's how the graph would look. So my apologies, yeah, this should have been the opposite, but these are correct. These are, as you can see, we sold the call and we bought the put in order to protect ourselves. So with that in mind, I hope it was helpful. Again, the names are very complicated. There's all these terminology, but the bottom line is you own the shares, you buy options, a put option to protect yourself, and you sell call to finance it. That's the bottom line. That's called color. So I thank you so much. Thank you for your attention. With that in mind, Sean, we can open for the questions if anyone has any questions.